Let's be honest for a second. Most of us are completely, utterly terrified of market crashes. And hey, that makes total sense. Watching your hard-earned money plummet in real time, it's genuinely scary. But when we actually dive into the data, it reveals something completely surprising. Most investors are actually terrified for the exact wrong reason. The real danger isn't the market dropping. No, the real danger is us interrupting our own compounding. So in this explainer, we're going to use this material as a sort of survival guide, and we'll see exactly how terrifying market crashes can actually be flipped into massive wealth-building discount events.
Okay, let's dive right into the framework we'll use to unpack all of this. We're going to cover 1. The fragility of compounding, 2. Why crashes are just normal math, 3. 3 steps you need to prepare right now, 4. The biology of panic, and 5. Proof that preparation absolutely pays off.
All right, first up, the fragility of compounding.
You know, we hear all the time that compounding is this magical force. Albert Einstein supposedly even called it the eighth wonder of the world. But the catch, and this is a big one, is that it is incredibly fragile when it gets interrupted. And that brings us to the asymmetry of losses. By definition, this is the mathematical reality where investment losses require significantly larger percentage gains just to break even. It is absolutely crucial to wrap your head around this concept early on, because mathematically speaking, losing ground means you literally have to sprint twice as fast just to get back to the starting line.
And this brilliantly illustrates the raw math behind it. Imagine you invest $10,000. Year 1, you gain 10%. Year 2, another 10%. Awesome, you're riding high at $12,100. But then, bam, a 40% market drop crushes your portfolio down to just $7,260. Now, here's the absolute kicker. To get back to your peak, you do not just need a 40% gain. No, you need a massive 67% gain. This right here is exactly why panic selling is so dangerous. It mathematically locks in a deficit that is devastatingly hard to recover from.
Moving on to part 2. Crashes are normal math.
We really have to shift our perspective here and stop treating crashes like they're these once-in-a-lifetime, unpredictable catastrophes, because they aren't. The historical data shows they fall into 3 routine, highly predictable categories. First, you have a correction, which is a 10% drop. These happen roughly every 1.2 years. So think about it. If you've been investing for 5 years and haven't seen one, you are statistically overdue. Next is a bear market, a 20% drop that rolls around every 4 to 5 years. And finally, a full collapse of 30% or more. Now, these are rare, happening maybe once a decade, think of 2008. But the reality is, if you invest for the long term, you will statistically experience all 3 of these. It's not a warning sign, it's literally just a feature of the system. It's just math.
Okay, section 3. 3 steps to prepare right now.
So the crucial point is that these are actions that absolutely must be taken today. Because once a crash hits the mainstream news, it's entirely too late to start building your shelter. The plan is super straightforward. Step 1, protect the foundation. Step 2, automate your dollar cost averaging. And step 3, properly diversify. This is basically the alchemy that transforms a terrifying market drop into a literal discount event for you.
So, step 1. This is saving 3 to 6 months of your full living costs in a high-yield savings account. And listen, this isn't about chasing a high yield. This is pure insurance for your compounding. During a crash, real-life emergencies still happen, right? Job losses, sudden medical bills, the car breaks down. Without this cash cushion ready to go, you'd be forced to liquidate your investments at the absolute bottom of the market just to pay your rent.
Step 2 is automating your dollar cost averaging, or DCA. Let's walk through this because the math is wild. Let's say you automate an investment of $200 every single month. Month 1, shares are $20 a pop, so you snag 10 shares. Month 2, the market crashes and the price drops to $10. Because you had it automated, your exact same $200 now automatically buys you 20 shares. Then in month 3, it partially recovers to $15, netting you roughly 13 shares. Over those 3 months, you accumulated 43 shares. But if the market had just stayed flat at $20 the whole time, you'd only have 30 shares. The crash literally accumulated more assets for you without you lifting a finger.
And step 3 is diversification. We're talking a core U.S. stock index fund, international markets, emerging markets, some bonds for stability, maybe some REITs for real estate. True diversification isn't just a safety net to catch you. It actually lets you dynamically rebalance. And rebalancing forces you to do the one thing that feels totally unnatural: selling what's high and buying what's low. Plus, it completely prevents a single sector collapse, like the financials in 2008 or tech in the early 2000s, from coming in and wiping out decades of your hard work.
Which brings us to section 4, the biology of panic.
You can have the most mathematically perfect, flawless strategy in the world, and it is completely useless if your own biology overrides it in the heat of the moment. I mean, have you ever opened your investment app, seen a giant sea of red, and felt a literal pit form in your stomach? Well, that is loss aversion. Hundreds of thousands of years of human evolution have hardwired our brains to treat dropping numbers as a literal physical threat to our survival. Our brains are practically screaming at us to stop the bleeding and run away. So, feeling the urge to panic sell? It's a fascinating survival mechanism. It is definitely not a character flaw. Psychologists Daniel Kahneman and Amos Tversky actually proved this in their landmark behavioral economics research. They found that the psychological pain of losing money is roughly twice as powerful as the pleasure of gaining that exact same amount. Think about that. Biologically, losing $1,000 feels twice as agonizing as gaining $1,000 feels good. Our own biology is fundamentally actively working against our long-term financial success.
So how on earth do we fight our own biology? Well, with a written investment plan. This is a physical document that you sit down and create when you are calm and collected, detailing your risk tolerance and the exact steps you are going to take if the market drops 20 or 40%. Think about legendary fund manager Peter Lynch for a second. His fund returned an unbelievable 29% a year, yet a massive portion of his investors actually lost money. How is that even possible? Well, their emotions overrode their logic and they panic sold. A written plan is the ultimate shield that stops you from becoming a part of that statistic. And finally, Section 5, proof that preparation actually pays off.
Let's bring this all home with some real historical receipts, setting up the stark contrast between those who panic and those who just stay the course. $1,820,000. According to a Fidelity study, if you had taken just $10,000, put it in the S&P 500 in 1980, and just left it completely uninterrupted until 2022, it grew to over $1.8 million. Through every crash, every recession, every panic. That is the unbelievable power of uninterrupted compounding.
Now, what's really interesting about the data is this dramatic drop to just $671,510. That is exactly what that same investor would have ended up with if they panicked and pulled their money out, missing just the 5 best trading days out of over 10,000 days in that entire 42-year period. Let that sink in. Missing just 5 days cost them over $1 million in returns. Insane, right?
Now you might be sitting there thinking, well, I just won't miss the best days. But here is the incredibly cruel irony of panic selling, and JP Morgan data backs this up perfectly. The absolute best recovery days almost always happen right during or immediately after the worst crashes. Get this, 7 of the 10 best single-day returns in the entire history of the S&P 500 occurred right in the middle of the 2008 financial crisis. If you leave the market because things look scary, you are practically guaranteeing that you lock in your losses and totally miss the explosive rebound that always follows.
To put that into perspective, let's look back at the 2007 crash. It was terrifying. A $100,000 portfolio dropped a stomach-churning 57%. If you panic sold, you essentially destroyed your wealth. But if you ignored the panic and just continued to let your automated DCA of $500 a month run, you were aggressively buying up shares at a massive discount. By 2021, those same shares had tripled in value. You accumulated cheap shares that basically set you up for massive wealth, which, by the way, is a pattern we saw repeat instantly during the lightning-fast 2020 crash.
So what does this all mean for us? Well, the most important takeaway from this explainer is this. The next market crash isn't a maybe. It is mathematically inevitable. But now we know for a fact that crashes are merely discount events for the prepared investor. So when the red ink inevitably starts pouring across your screen, will it destroy your wealth or will it accelerate it? That choice, honestly, entirely depends on the steps you decide to take today.